Welcome to Ilagan Whiteboard Friday, where we look at complex legal and compliance issues in a simple to do way. This series is brought to you by Ilagan, your partner and provider of end-to-end business services.
Hello and welcome to another episode of Ilagan Whiteboard Friday. This is Vikas from the Ilagan team, and I have with me today Mr. Naeem Zafar. He is the president and CEO of Bitzer Mobile, and also a lecturer at the Haas School of Business at UC Berkeley. So today we want to talk about how much money is good enough. So we may have to raise angel funding, or an entrepreneur may have to raise VC funding, but sometimes they don't know what is the right amount of money. People say you raise too less, you raise too much. What is the right amount of money to raise at what stage, and how do you calculate that?
So first thing you have to do is do a financial analysis to figure out, create a financial model that how much do you need, when do you need it. So I've written a book actually on this topic called Finance Essentials for Entrepreneurs, which helps you build a financial model. Because this is how you know you need $500,000 and $1 million. You start by making a list of all the people you need, when you need them, and you multiply with a salary. So that's 80% of the business expense anyway. How much you need to raise, ask yourself. Company in the beginning has a lot of risk.
Yeah.
Execution risk, market risk, technology risk. Where does the company need to bring so at least I can reduce the risk? And then how long does it take to go from here to there? If this takes 9 months, then you raise enough money to survive 9 months plus 6 months for raising money. You need money for 15 months. And the financial model will tell you every month how much you're expecting to spend.
So what are these financial models? Can you just give?
It's a simple Excel spreadsheet.
Okay.
Which just shows that, in first month, I need to have, a CTO and one developer.
Yeah.
In second month, I need a second developer. Then month 3, 4, this small team will work. Then month 4, I'll need a QA guy and a marketing guy. Then month 8, I need also 3, 4 additional people. So that gives you an idea of who do you need to hire. Now, how much salary are you expected to pay? You have that one column. You multiply the numbers and you kind of get an idea.
So you have a matrix for the expenses that you foresee for a certain amount of time. Now,
Couple of years.
Okay. And on top of that, a lot of times people don't have, when they're starting out, they don't have understanding of what kind of marketing budgets that may be required.
Yeah, so don't worry about that. I think what a simple thing is when you have a people expense, I usually multiply by 25%. And that takes care of rent and some travel and some office expenses. I don't have to worry about each individual item. Then marketing expense, you see, when you want to start marketing, you just estimate, in my case, I'm estimating like $10,000 per quarter.
Yeah.
Put some number there other than zero.
Yeah.
You don't know and you don't need to know because you don't need to be precise. You need to have some idea how much you need.
So I have a lot of technical entrepreneur friends and a lot of our clients, and they don't understand the finance because they think they're the greatest technologists, and a lot of them truly are. How much do they really need to know the finance essentials?
So that's why you can see the book is a skinny book. It's not a thick book. You don't need to know a lot. I'm an electrical engineer. I never did any finance. So all the finance I learned and put it here. Is basically just need to know Excel and some basic concepts.
But you need to know those basic concepts.
You need multiplication.
Yes.
And you need to know Excel. If you don't know those two, then find somebody who does.
Yeah. Okay. Now, once you have raised money, what kind of shares do you give to the VC?
But before we go there, we still have more to tell you about how much to raise.
Okay.
So idea is to de-risking the deal. So what's an example of de-risking the deal? Like I said in the very beginning, you have at least 3 risks. Technology risk, market risk, execution risk.
Okay.
So let's say 4 months later, you have a prototype. So prototype tells you that at least you have mitigated the technology risk. Now company looks a little bit more, risk has been reduced, the company value has gone up. The next time you have 4 customers. Then you have some market acceptance. So you have reduced the market risk. So you raise money, you figure out when these points will hit, plus 6 months for time to raise money, and that's the amount of time you need to raise money for. You don't want to raise all the money up front because why? In the beginning, your company has no value, maybe very little value. Suppose company value is $1 million. And if you're raising 10 million, you've given up 90% of the company. Then what's the point? So you want to raise just enough plus 6 months so that you can, at that time when you raise more money, your company value has gone up and gone up again. So you don't dilute the company so much.
Okay. Now, when when so let's say you're 6 months into the company, you are ready to either raise your first angel round or you're ready to raise your first VC round. Now, at that point, do you have to have clarity in terms of, I think I'm going to need $1 million today, but 2 years from now, I need $10 million, and how clear that has to be? Or they know that, okay, I just need $1 million and I worry about the next phase when it comes to it.
That will get you kicked out of the investor's office. The picture you want to be able to draw is something like this. So this is dollars you need, and this is time.
Okay.
If you cannot draw this picture, you're not ready to talk to investors. This picture actually tells you several things. It tells you how long before you'll turn the corner and start making profit.
Yeah.
This tells you how much money you're going to lose before you turn the profit and how much total money you need to raise. It tells you what is your run rate, your slope, when you turn the profit. It tells you how long this time will be when you start turning the profit. It tells you how much money will you make by the time year 5 comes around. How much money will you be making? So it answers many questions. It's a simple picture.
So does one have to have the first funding that they have? Does it have to cover the whole dip here, or so how far?
Risk, the technology de-risk.
Yeah.
So when you look at a company at this point may have risk is here. Next time risk is here, then risk is slowly coming down. This could be T1, this is T2. Milestones where the de-risking happen, all can happen in here.
Okay.
So it could be, if you just expand this area,
yeah.
You have this much risk in the company. Over time, you bring the risk down here by doing your prototype. How long does it take to go from here? This could be, 6 months, 5 months. This is all inside here. If you raise all the money you need, that's all the money you need to get to profitability.
Yeah.
That you may give away too much of your company.
So now, going back to the question, so on the day one that they decide to that, okay, 6 months in, we have done our homework, we are serious about it, we have a business plan. Now, do they have to know when is the next time they're going to raise the money or no?
Yes.
Yes, they have to know that.
Well, they have to have some idea that how long does it take to get a prototype?
Yeah.
How long would it take to get the first 3 customers? Those are the proof points.
And those scenarios can always change over time, but they need to have a starting, because you may have
always change anyways.
Like Groupon had a great growth, so they would probably just go out and raise more money.
Yeah, it's like if you're trying to decide to take a trip from here to Los Angeles, whatever you decide, you're going to stop someplace, you're going to see some scenery, it'll change, but you have a general direction where you're going, and you have a general plan how to get there.
Okay.
And then there'll be many deviations, but that's normal. But I have no plan. You just take off, you're maybe going totally the wrong direction.
Yeah. All right. Thank you. And we'll see you next week in another episode of Ilagan Whiteboard Friday.